All right. So, good afternoon and a warm welcome to all the participants who have joined for this webinar on the overview of Indian debt market. So, today we have here with us Mr. Vijay Kanchan, our distinguished speaker. It's my pleasure to give you his brief intro. Mr. Kanchan is a capital professional for more than 30 years of experience. He was a head of institutional derivatives at JM Finance, Daulat Capital Market, and Prabhudas Leeladhar. He was also head of proprietary trade at Mangal Keshav Security Limited. He has experience across different verticals, including institutional dealing, derivative research, proprietary trading, issue management, depository operation, client servicing, etc. He's a visiting faculty for finance at XLRI Jamshedpur, NMIMS Mumbai, KJ Somaiya Institute of Management Mumbai, NL Dalmia Institute of Management Mumbai, St. Xavier's Institute of Management Mumbai, NIFM Faridabad, IBS Mumbai, BSc Training Institute, NSC Training, and NISM. He's NISM empaneled trainer for equity derivative, currency derivative, interest rate derivatives, and investment advisor. He has trained more than 8,000 market participants in the past 5 to 6 years. He holds a management degree in finance from JBIMS. So, sir, without taking much of my time, I would request you to take it forward from here.
Uh, Thank you, Rajalakshmi, for those kind words. Good afternoon, everyone. I'm Vijay Kanchan here. Uh, it's often said that a truly efficient portfolio should be well diversified across different asset classes like equities, bonds, gold, commodities, real estate, currencies, etc. Uh, Today, I will take you through one such asset class, which is bond, sometimes also called as debt instruments or fixed income securities. Uh, this is going to be an overview of the debt markets, and it's not something, to be very honest, that can really be covered in 1.5 an hour. Maybe sometime in the future when we have a full-fledged session, most of the points that we discussed today, I think it will be a pleasure to cover all those. So today I'm only going to give you the overview of the debt markets, the different types of products that are currently available in India, and some debt terminologies that you may have heard about it or read it in the business publications. I'm going to begin right away by sharing the screen. Basically, when we speak about the markets, the financial markets in particular, we are referring to four major or four fundamental asset classes, that is money, bond, equity, and the forex market. There's a currency market. We also have commodities, but strictly speaking, commodities are not part of financial markets. They are separate markets by themselves. We call them fundamental because all these asset classes are completely independent, and historically, people have invested in these asset classes one time or the other. Money and bond markets, taken together, uh, would be called as the debt markets or the fixed income securities, which is what we're going to talk about today. And your debt market and equity markets taken together, we call them the capital markets because these are the two important sources of finance for any corporates. Debt markets, like any other markets, is a market where buyers and sellers meet and they trade in various debt instruments. Uh, why do we need a debt market? For any growing economy, and an economy like India, which is poised to become a 5 trillion or even later on a $10 trillion economy, you need a vibrant debt market. Okay, because there is a limit to how much the banks can lend. And honestly speaking, it's very difficult to be a very large economy without a full-fledged debt markets in place. Uh, why do we need the market? Because in a way, the markets help allocate or reallocate resources from those who save money uh, to those who have an actual need for money, right? The markets have seen significant changes, particularly during the last decade, some of which I will show it to you right now. So we have an electronic screen-based trading, we have a dematerialized holding, we have straight-through processing. Straight-through processing is basically an automated system of settling funds and trades where you have minimal human interaction. The establishment of CCIL almost 2 decades back has been a major innovation in the market because it acts as a counterparty, it guarantees settlement, and a lot of changes have taken place in the legal environment, which have contributed to the rapid development of the market. Uh, why do we call it a fixed income securities? If anyone of you can answer this, does fixed income means a guaranteed return? Would anyone be able to answer this? Does it mean a guaranteed return? Uh, are you able to see my screen clearly? Rajalakshmi, I think one of the
Yes, sir.
participants has said he's not able to see the screen.
The screen is visible, sir.
Visible?
Yes, sir.
Fine. Uh, a fixed income security does not mean a guaranteed return because there is something called as credit risk. What I essentially mean here is a company or a corporate can default. Why do we call it a fixed income security? Because these cash flows or these periodic interest payment, they are known in advance. They are fixed and they are known in advance. And that is why they are often referred to as a fixed income securities or a fixed income market. So this is how it looks like. You have an issuer, you have an issue date, you have a term to maturity, and then you have the maturity. And in the interim period, the issuer will pay you coupons if it is a normal bond. Of course, there are different types of bonds which don't pay coupon or which pay a variable coupons. We'll come to that later. Right. These are the policy rates in India. This is as on yesterday. Uh, all of these I'm going to discuss in a little more detail. So you have the policy repo rate, which is currently 6.5%. The RBI has kept this rate constant now for quite some time. This is the standing deposit facility rate. This is the rate at which banks can park their excess funds with RBI. This is the marginal standing facility rate, which is at 6.75%. Uh, this is applicable, sometimes often called as a penal rate for banks which have liquidity issues and they want to borrow from RBI. So this is the rate which is applicable. The bank rate generally follows the MSF rate. RBI, as a matter of policy, has seen that the bank rates and the MSF rate move together. Fixed reverse repo rate is the rate at which RBI borrows from the bank, which currently is at 3.35%. The cash reserve ratio is the amount of cash which a bank needs to deposit with RBI as a function of their net demand and time liabilities. SLR is the statutory liquidity ratio. There are eligible securities which qualify for SLR, and the bank need to maintain this percentage. These are the exchange rates as on yesterday. Why do we need a bond market? I mean, what are the advantages and disadvantages of the bond market? Uh, Importantly, it's a very good long-term source of capital, and there is no dilution in control because your bond holders are not part owners or owners of the company. As far as investors or lenders are concerned, they will get the promised interest as per what has been promised. The document which gives all the terms and conditions, it is called as the bond indenture. It is a legal document. Uh, from the company's perspective, the future obligations are known, and the interest payment which they make is tax deductible not only in India, is in many jurisdictions all over the world. It's easier for a company to raise a large amount through debt because most of this is privately placed as compared to a equity where you have to go through the public issue route. Uh, it's generally seen that bondholders have more commitment than equity holders. So you have bondholders who are generally long-term investors, relatively speaking, compared to equities. In the long run, as long as it is not very excessive, debt works out to be cheaper than equity. Of course, this comes with the caveat. The company cannot indefinitely keep on raising debt because beyond a point, debt will no longer be cheaper because the company is now playing with leverage, and the cost of debt and the weighted average cost of capital will go up for such companies that they are using too much of debt. But within a limit, certain limit, long-term debt is cheaper than equity. Uh, what are the disadvantages of having debt? Within the bond indenture, there are certain covenants. Covenants are basically do's and don'ts for a corporate at the time of issuing debt. The covenants come with may have certain restrictions regarding exposure, expansion, disposal of assets, etc. So, if the covenants are very restrictive in nature, that may restrict the company's core activities. We all know that, irrespective of the fact whether the company is making a profit or not, the debt has to be repaid, and sometimes this can lead to liquidity issues. Companies, especially those companies which are using short-term debt, like commercial papers, can have a rollover issue if they are unable to refinance their debt. Something like this happened way back in 2018 in India in the aftermath of NBFC crisis, where companies found it very difficult to roll over their papers. If the company is using too much of leverage, this can, in a way, jeopardize the growth and increase the probability of default. And also, such companies which have a very high debt to equity ratio, they are considered risky by the lenders and investors. And we all know that companies having high debt to equity will not command a rich valuation in the market. So their P, for example, will not be as high as a similar company, but which uses negligible debt in their capital structure. Uh, there was a question when dollar to rupee is high, how Sensex and GDP is growing. This is, I think, one of the participants had asked. This is something which has not happened today. The rupee USD INR rate is a function of many things, including inflation, growth rate, interest rate in the economy, employment level. There's so many things. The dollar is a very strong currency, so it is not only against the rupee. Dollar practically appreciates against most currencies in the world. Okay, fine. This is, you have the sovereign issuer, which is the government of India, and you also have the state governments. Then you have the public sector. Public sector are those, the banks and companies where the government has substantial holdings. And then you have the private sector, which are your corporates and the private sector banks. These are some of the instruments which are in vogue in India, and these are the investors. So one of the biggest player in the debt market would be your banks, especially the government debt. And you have other long-term investors like pension funds, insurance companies, provident funds, etc. who are also major players in the debt markets. RBI is a player as well as a regulator in the debt market. SEBI regulates the corporate debt in India. Uh, the debt market is gaining traction, particularly in the last few years. We are now seeing increasingly high participation by the high net worth individuals, the qualified institutional investors, family offices, etc. Retail participation has improved, but it is not very significant because one reason is very few people understand the way the market functions, and retail investors have a preference, if not equity, then they have a preference for bank FDs, post office schemes, etc. Just have a look at the government G6 and corporate bonds outstanding. They have grown by more than 165, 170% in the last 10 to 12 years. Outstanding government debt is now approximately slightly more than 100 lakh crores. The outstanding corporate debt is slightly more than 45 lakh crores currently. So this is what figure here is a 2023 figure. Government borrowing, if I were to look at the 2024 full year figure, was about 15 0.43 lakh crores in 2024 is a long way off. I mean, compared to about 5 to 6 lakh crores about 10 years back. Uh, so this is how the markets are growing. If you can see for yourself, they have grown by leaps and bounds. And just reiterating what I mentioned earlier, you need a vibrant bond market for a fast growing economy. Fine. Uh, And Amit Naik has asked the question, why would one invest in a GSEC mutual fund when RBI? Uh, Amit, it's a choice given to you. Just like what we have in equities, you can go via the mutual fund route, or you can invest directly in the market. The choice is with you. The only difference here is your GSEC mutual fund manager would be an expert in the bond market, and probably he'll be able to manage the whole thing much better than you and me individually. Fine. Some of the measures in the last 10 years, RBI Retail Direct Scheme will now provides you easy access to, especially the retail investors. Earlier, it used to be a wholesale debt markets. Practically all over the world are actually wholesale markets. Uh, Now, even with an investment of 10,000, you can buy a GSEC or you can buy T-bills directly from the market using the RBI retail window. Uh, Minimum investment in corporate bonds have now been brought down to rupees 1 lakh from the earlier 10 lakhs, and there is a talk of bringing it further down to 10,000. You can participate in the bidding. I will explain this in detail when I come to the relevant part. So even in the primary auctions, you can participate in the non-competitive bidding because you will be allotted uh, either the T-bills or the G6 at the rate at which it was decided in the competitive bidding process. Odd lot segment is now applicable for the retail investor. There have been a lot of regulatory frameworks for online bond platforms where RBI has allowed the sale and purchase of G6 on this platform. What SEBI has done is they have limited the number of ISINs in a year. So this ensures liquidity in the corporate bond market. Let's come to what is the heart of the money markets, and that is the call money markets. This is a market for unsecured borrowing and lending of funds. RBI has now made it purely an interbank market. So the market is restricted only to the commercial banks and the primary dealers. It's an overnight market where you know a, a bank may have surplus liquidity and one bank will probably have poor liquidity. So the call money markets takes care of the short-term liquidity issues, the banking system. Notice money is an extension of the call money market. So anything from 1 day to 14 days, we call it as the notice money. And the term money is again an extension of the interbank call market for unsecured borrowings. And anything between 15 days to 1 year, we call it term money markets. Uh, though over the years, the total volumes in the call money markets is, I mean, significantly lower compared to what we see in the repo market and the TREPS market. But RBI gives a lot of importance to what is happening in the call money market. And because as far as RBI is concerned, uh, the rate in the call money market is their operating target for all monetary policy decisions. So even though the volumes are significantly lower compared to what we see in TREP and the repo market, but RBI takes whatever is, because call money market reflects short-term liquidity in the economy. Let's have a look at some of the instruments here. Uh, Kushagra, I will answer your question a little later when we come to the end of the session. When is the right time to invest in the bond market? Because otherwise, if I go on answering individual questions, I may not have enough time to finish off the content today. Okay, so T-bills are short-term money market instruments issued by the government of India. They are currently issued in three maturities: 91 day, 182 day, and 364 day. Earlier, we also used to have the 14-day table, which RBI does not issue any longer. I think they're only restricted to state governments. So basically, what are T-bills? These are like a zero coupon bond or a zero coupon security. They pay no interest because they are issued at a discount and they're redeemed at par. So let me give an example here. A 91-day table, suppose if it is issued at 98.50 and it is redeemed at 100 in 91 days, this is how we calculate the yield. The yield works out to 6.1081%. This is the calculation. This is called as the money market yield, or sometimes also called as BY or the bond equivalent yield. So this is the calculation. So the difference between the face value and the issue price divided by the issue price. Okay, what I'm doing is I am scaling it to 365 days. So I'm using this function 365 divided by 91. And of course, the percentage I multiply by 100. So it comes to 6.1081%. So this is the money market yield for T-bill, which has been issued at 98.50 when its face value is 100. Okay. Uh, One question was asked is what is the meaning of money markets? Money markets is a market where you have all instruments which have a maturity of less than 1 year uh, trading. Okay, so if a bond which is has a maturity of let's say 3 years or 4 years, it is a part of the bond market. In the money market, you have all such instruments which have a maturity of less than 1 year. Okay. The commercial papers are again a type of unsecured money market instrument issued in the form of a promissory note. It was first introduced in India in 1990. Now, what are commercial papers? It allows highly rated companies, highly rated corporates to diversify their sources of short-term borrowings. And as far as an investor is concerned, it provides an additional instrument. So corporates, primary dealers, financial institutions are allowed to issue commercial papers, provided they have a net worth of at least 4 crores. Currently, CPs can be issued for a minimum period of 7 days up to a year. Generally, we see a lot of CP paper, coming around 270 days or thereabouts. So CPs are also issued at a discount and redeemed at par. The difference between the issue price and the face value becomes the implicit yield here, just like the T-bill. The minimum denomination has to be 5 lakhs and multiples thereof. CPs have to be rated by the rating agencies, and the minimum rating for issuing a CP has to be at least A3 and above. Just like the T-bills, we have the cash management bills. This was first introduced in India in 2010. They are very, very similar to T-bills. They are basically issued when the government has a temporary mismatch in cash flows. Uh, they have they have the generic characters of tables, but they are used for maturity of less than 91 days. So your CMBs can have odd days like 21 days, 30 days, 40 days, etc. So CMBs are issued for maturities less than 91 days. Certificates of deposits are is a negotiable instrument. It is very, very similar to a fixed deposit issued by the bank. The only difference here is the fixed deposit is not transferable, whereas the certificate of deposit is a negotiable instrument, which means it can be traded in the market. They are generally issued by banks and have a validity of maturity of up to 1 year. So your commercial banks, regional rural banks, small banks, etc., can issue CDs. CDs are also issued by All India Financial Institution, and they have a maturity of up to 3 years. Like your CP, your CD has to be issued in a demat form. They have a minimum denomination of up to 5 lakhs and multiples of 5 lakhs thereafter. The tenor of the CD will be not less than 7 days and will not exceed 1 year in case of the banks. Uh, CDs can be issued at a discount to face value and redeemed at par. Sometimes it can also be issued on a fixed or a floating rate basis. Uh, Dhananjay, GSEC is better than corporate bond in terms of the credit quality. You don't expect governments to default. Uh, People buy GSEC, will buy GSEC when they are not sure about the credit worthiness of the corporate bond. Having said that, a corporate bond will always give you a higher yield compared to GSEC. So somewhere in between, you have to manage your risk and reward. If you invest in corporate bonds, you'll obviously get a higher coupon, but there is always a possibility of a default. Uh, the government introduced a product called as the CBLO way back in 2003. It's called as collateralized lending and borrowing obligations. Uh, it is a short-term instrument where lending and borrowing can happen. The difference between a CBLO and other short-term instrument like T-bills is there is a collateral involved here. So your lending and borrowing is supported through a collateral, which means the risk of default is practically not there. So who can participate in the CBLO market? It are they are your insurance firms, mutual funds, the commercial banks, private banks, pension funds, etc. Now what has happened is since 2018, this instrument has been rechristened as a tri-party agreement, sometimes also called as TREP, where CCIL is now sort of a counterparty here, and it guarantees all the repayment of loans. So the product has now become much more popular. CCIL acts as an intermediary between the two parties, and it also helps facilitate services like your collateral selection, payments, receipt payments, etc., settlements, custody and management during the life of the transaction. In fact, the trap market is a very big market in India with an average volume of about anywhere between 4 to 5 lakh crores per day. Uh, let's have a look at the government security or a GSEC. A GSEC is a dated security issued by the central government from time to time. This uh, carries a fixed rate. So most of the GSECs that have been issued in India are fixed rate instruments which are paid on the face value. The face value is typically 100, and the payments happen on a semi-annual basis. So the government bonds which are issued in India, just like many other government bonds issued all over the world, make a semi-annual. Uh, they carry no risk. So, can someone tell me why a bond issued by the government in its domestic currency it carries no risk? Can someone answer this? Yes. The two things here: the government can print money, and the government can raise taxes. So, technically speaking, a government cannot default on its domestic borrowings. The government can default on its overseas borrowings. For example, the government of India has borrowed in dollars or euros, and if they have some issues, it is possible that they can default. But the same thing will never happen for a INR borrowing as far as government of India is concerned. G6 issued in India uh, have ranged from 5 years to 40 years. The RBI is the main body here. It functions like the public debt office. It acts as a registry or the registrar and the depository for G6. And it is what they do is they issue interest payment and they look after the redemptions. So basically, everything right from issuance to redemption is taken care of by the RBI. What we have seen in India is most of the dated securities or most of the G-SECs that have been issued are actually fixed coupon securities. Once in a while, the government issues a floating rate bond. So this is how it looks like. So a G-SEC which has a maturity of, let's say, this was issued in 2018. So it will, the nomenclature will be something like this: 7.17% G-SEC 2028. So this is how it is. The coupon which is paid is 7.17%. The name of the issuer is Government of India. Date of issuance January 8, 2018. Maturity is January 8, 2028. It will make coupon payments every 6 months, half yearly. So one payment will be on July 8 and the other payment will be January 8. Right? So minimum amount of issue sale is 10,000. The next would be a floating rate bond. Unlike the fixed rate bond, the floating rate bonds have variable coupons. Means there is no fixed coupon here. The coupon rates may change. So it is reset typically every 6 months or every 1 year, as per what has been promised in the indenture. And they are generally linked to some benchmark. So it could be, so let me come to that. So FRBs were first issued in September 95 in India. The variable coupon here will be the average of up to two decimal places of the implicit yields at the cutoff prices of the last three auctions of the 182-day tables held before the date of notification. So whatever the rate that was decided in the auction becomes the coupon rate. The average of last three rates becomes the coupon rates for the floating rate bonds in India. Sometimes the floating rate bond may have a base rate plus a spread, which is decided by the auction mechanism. The spread will mostly remain same throughout the tenure of the bond. The spread reflects in a way the credit quality of the issuer. So higher the quality, lower will be the spread. Lower the credit worthiness of the issuer, higher will be the spread. So this such type of bonds are very famous, particularly in the US markets. The floating rate bond will have, you know, a floating rate benchmark. It could be, let's say, a MIBOR or a LIBOR, or now SOFR in US, and plus it will have a spread of 50 bips or 100 bips. The difference in the between the, I mean, uh, any spread above the floating rate is reflecting the credit quality of the issuer. As I mentioned earlier, lower the credit rating, higher will be the spread. Uh, Dr. Poonam Lohana has asked a question. How does inclusion of India in global debt market help Indian economy in detail? It will attract a lot of capital flows, Dr. Poonam. So there is a likelihood that eventually it would strengthen the rupee. So your uh, government debt will become part of the JP Morgan index sometime in June, July of this year. And we will also become part of the Bloomberg Emerging Market Index. So the expectation is India can attract anywhere between 50 to $60 billion in capital flows, and that would be good for the rupee. Let's come to the callable bond and the puttable bond. These are uh, special types of bonds which have what we technically call as an embedded options. Now, what is a callable bond? The callable bond gives the issuer the right to call back these bonds before maturity. So, suppose a bond was issued which has a call feature after 3 years. This is a 10-year bond, which means after 3 years, the issuer can call back the bond. Why do you think the issuer will call back the bond? He will do that because the interest rates in the economy would have come down. So by calling back the high coupon bonds, he can reissue fresh debt at a lower cost, right? So this is the meaning of a callable bond. For an investor, this is a negative feature. So generally what happens is because of this risk, what we technically call as a call risk, investors demand a higher yield at the time of issuance. So the issuer has to pay a slightly higher coupon compared to an otherwise option-free bond whenever he issues a callable bond. The opposite of this is a puttable bond. In the puttable bond, the right is with the investor. Okay, recollect, in a callable bond, the right was with the issuer to call back the bond. The investor never had any right here. But in a puttable bond, the investor has a right to sell back the bond to the issuer after a certain period of time. I'm taking the same example. A 10-year bond was issued, which has a puttable feature of 3 years. Means when I say 3 years, this is called as a protection period. During the protection period, a bond cannot be callable or it cannot be puttable. So after 3 years, if the interest rates have risen in the economy, the investor will give the back, surrender the bonds back to the company at its face value, and he will reinvest at a higher rate of return in the economy. Because this is an additional feature which benefits the investor, putable bonds can be issued at a lower yield compared to an otherwise similar option-free bond. The first GSEC, which had the embedded options, was the 6.72% GSEC issued on 2002, which matured in 2012. Uh, the option to convert lies with the issuer in a callable bond. I mean, not convert, the option to uh, take back the bond lies with the issuer in a callable bond. The option to return the bond back to the company lies with the investor in a quotable bond. Abhit Nayak has asked the question, we have a liquid and vibrant equity market. How do we make our debt markets liquid and efficient? Amit, my personal view is this decade, next 5 years, 10 years, 15 years is going to be the decade of, I mean, the debt markets. A lot of reforms are taking place. Uh, the of course the two important development, the major development is what we discussed. RBI's effort to make this market much more broad based. The inclusion of Indian bonds in the JP Morgan index, in the Bloomberg market index, and of course efforts undertaking by the regulators and others to create awareness about the debt markets all over the country. Uh, I- from an investment point of view, in the just bear with me for some time. I will tell you why this is a right time to invest in Indian equities. So I'll come back to you, Amit. In a capital index bond, the principal is linked to an accepted index of inflation. It could be your CPI, it could be WPI. The idea is to protect the principal amount of the investor from inflation. In India, the first capital index bond was issued in December 97. It was a 5-year capital index bond. In an inflation index bond, both the principal and the coupon are protected against inflation. The index used here could be WPI or CPI, as mentioned to you earlier. Globally, the first uh, inflation index bond, it was issued in UK way back in 1981. In India, the RBI had recently issued IIBs, which was linked to WPI in June 2014. Once in a while, the government also issues special bonds or special securities. This is basically bonds are issued in lieu of cash subsidies. So they are issued to oil marketing companies wherever the governments have given subsidies. They could be given to fertilizer companies. They could be given to Food Corporation of India, etc. So such bonds would be called as oil bonds, fertilizer bonds, food bonds, etc. They are usually long-dated securities. uh, it reflects the liability of the government to these institutes, and most of the time it is an off-balance sheet item. They carry a higher coupon yield or a yield over other such similar securities, but they are not regularly issued. They are issued once in a while. This is one more fascinating instrument, strips, also called as separate trading of registered interest and principal of securities. Now, what happens in a strip is the strip program or the government strip program allows each and every cash flow to be separated. Let me give an example. You have a 10-year bond, okay, which makes a semi-annual coupon payment. Now, this bond has 20 cash flows as far as coupons are concerned. It has 20 cash flows as far as coupons are concerned and one principal repayment. So altogether, it has 21 cash flows. Now, in a strip, what will happen is each and every coupon is stripped and sold separately as a zero coupon bond. How does it benefit? Because if it is sold as a zero coupon bond, there is going to be no reinvestment risk here. So for long-term investors or institutions which have long-term liabilities like your pension fund, your insurance companies, your provident funds, etc., they would prefer such bonds, okay, because there is no reinvestment risk here. So they will, because their liabilities are all long-term liabilities, so they would prefer to own assets which are also long-term. And strips, especially the far dated strips, okay, uh, 10-year, for example, 10-year strip, which will now have 20 such cash flows. So they will buy the 18, the 19, 20, or 17, 18, 19, 20 cash flows. So these instruments will carry no reinvestment risk. They will be redeemed at face value at the time of maturity. SIPS trading in India has picked up significantly in the last 6 to 7 years. Now, this was one product which was practically ignored by the market. If you look back at the volumes, it hardly used to be 10,000, 15,000 crores in a year. From there on, we are very close to, on an average, 2 lakh crores every year happening in the STRIPS market. So they function as a zero coupon bond created out of existing securities. And unlike the other bonds, these are not created out of auctions. They are created out of an existing security. Each and every cash flow is stripped and sold separately as a bond. Sovereign gold bonds, relatively recent, uh, one very good way of investing in gold, because it is an electronic form of holding gold. You can buy even minimum of 1 gram up to 4 kg in a given year. They have no capital gains if you hold it for 8 years. It pays 2.5% every year on a semi-annual basis. After 5 years, you're allowed to redeem it, but of course, it will be taxable should you have a capital gains here. So the coupon is 2.5% per annum, and your basically it reflects gold prices. The government is holding gold on your behalf. Prakar has asked the question: how does an investor suffer loss in case of a callable bond? Prakar, what happens is when interest rate goes down in the economy, your normal bond price will start rising. The same thing will not happen with the callable bond, because everyone in the market knows that this is going to be called back, generally very close to the face value of the bond. So potentially he loses out. And what happens here is uh, when the interest rates decline, the price of the bond goes up. So he will get his money back at a very wrong time, because he will now be forced to reinvest at a lower return rate of return in the economy. Prakar, is it okay? Uh, just like the central government, your state government also issues the dated securities. They are called as state development loans, or SDS. The RBI is a merchant banker for SDS, and just like the GSECs, this is also issued through a normal auction process. Interest are paid half yearly. The principal is repaid on maturity. For the purpose of SLR, your SDLs also qualify. Remember, when I spoke about SLR, I spoke about eligible securities. SDL is one of those eligible securities for the purpose of SLR calculation. Additionally, State Bank also have issued special securities for their operational and financial turnaround of distribution companies. These are called as discoms and Uday. Uh, so Uday and discom, just to give an example, these are instruments issued by the state government of India for a specific purpose. Let's have a look at the debt market auctions. There are basically two main types of auctions. There is a third type also. We'll talk about it. Uh, a yield-based auction is generally conducted when the government comes out with a new issue. All the investors, the qualified or the eligible investors, can bid up to two decimal places uh, like this. So bids would be arranged in an ascending order, and the cutoff yield is arrived at the yield corresponding. So At a given level, whatever has been the issue size is completely absorbed by the bits which has been calculated by RBI. That becomes the cutoff yield. This becomes the fixed rate for the security. So all those who have bid at or below the cutoff yield will be allotted the securities, and all those who have bid higher than the cutoff yield, their bids will be rejected. This is an example of a yield-based auction. Similarly, we have a price-based auction. A price-based auction will happen when the government of India reissues an existing security. So here what happens is the bidding will take place in terms of price and not in terms of yield. So bidder will, for a 100 rupee security, they will give a quote. There is going to be a cutoff price above which everyone will be allotted, and all the bids which are below the cutoff price will be rejected. In addition to these two options, you have also have a multiple option, which was not so popular in between, but the RBI has also now recently started, having multiple options in which the bidder will be allotted the bond at the price at which he has bid. Sometimes what will happen is the bid would have been very far away from the cutoff price, and the bidder will still have to accept the, for example, let's say the cutoff price was maybe about 7.05 or something, and the bidder actually bid at 6.95. Just to give an example, because he bid at 6.95, he will be allotted at the rate of 6.95, which is actually speaking in a way a loss to him. This is called as a winner's curse, which happens in a multiple price auction. Uh, Two types of biddings take place. One is a competitive bidding. In a competitive bidding, all the large institutions, the banks, the insurance companies, pension funds, primary dealers, etc., these are professionals. Okay, so they will take part in the competitive bidding in the option process. The RBI, of course, has the final say here whether to accept or reject the bids. In a non-competitive bidding, this involves small investors, retail investors, cooperative banks, etc. They can take part in the non-competitive bidding process with bids up to 2 crores per security per auction. They will have to accept, if allotted, the price or the yield which was discovered in the competitive bidding process. Satyendra has asked a question. Does bonds have a compounding returns element in it? Uh, yes and no, Satyendra, because if the bond pays a semi-annual coupon, you will not get the benefit of compounding. There are certain bonds which pay, like a zero coupon bond, for example, which would pay you a fixed amount at the time of maturity. So here the compounding returns does matter. Uh, in general, when we look at the money market instruments which are less than 1 year, we generally don't take into consideration the effect of compounding. But all dated instruments, especially if see, it again depends on Satyendra on what yield you have bought it. The yields keep on, though the coupon is fixed, the yields keep on changing in the market. Suppose at one point of time the yields were very high, you'll be able to get the bond very cheap. You'll be able to get the bond very cheap, in which case your compounded annual CAGR will be very high. Uh, I may not be able to explain this without the help of an example, Satyendra. Maybe some other time when we have a full-fledged session, I can show you this with the help of calculations. Amit Naik is asked, call option gives you a right to buy. Yes, yes, Amit. It has, you have a right to buy, but in this case, the right is with the issuer and not with you. Chandini has asked, is this the right time to enter into the debt market? Chandi, I would request you ask this question in the last 5-10 minutes. I will then explain why it is the right time to enter the market now. Uh, Amit, yes, put option gives you the right to sell in the bond market, in the context of the bond market. When you're buying a portable bond, you have the rights and not the issuer. Uh, Viral, insurance is completely different. You, as an investor, will make a much better IRR if you use a judicious mix of good bond products and term insurance. Whatever you would be able to generate as a individual will be much better than what the insurance companies offers you. Satyendra, yield to maturity is the internal rate of return for a bond. Means if you buy a bond today and hold it till maturity, okay, and you are reinvesting the coupons at the same rate of return at which you bought. When I say rate of return means the market yield, not the coupon rate. So in short, yield to maturity is the yield you earn if you buy a bond today and hold it till maturity. That is what YTN stands for. Amit Naik has a question: zero coupon bond taken at a face value and paid the maturity amount, hence does not pay any interest. In this case, Amit, there is no coupon payment, but whatever is the difference. For example, a 10-year bond, you bought at, let's say, 520 rupees and it's going to be redeemed at 1000 rupees. तो ये दोनों के बीच में जो difference है ना, that is the actual what you call earnings to you, the yield to you, right? Once in a while, the RBI conducts open market operations. Basically, what is open market operations? It is buying and selling of the government bonds. It is done by the central bank in order